Rob Beardsley, welcome to the Capital Raiser Show. How are you doing today?
I'm doing well. Thanks for having me.
Cool, man. I saw you originally on the Multifamily Investor Nation Summit. You were just on there again. You are from New York. I know that you have 50 million of assets that you've purchased in real estate and multifamily syndication, I believe. Have all of your deals been multifamily syndication, or have you done some joint ventures?
Yeah, we've done some personal deals. We've done JVs, like you said, with more institutional type partners, but we have done a fair bit of syndication as well.
Cool, man. Well, let's dive in, man. Tell us a little bit about your background and how you got into real estate investing. Because I've been on your Instagram and there's like pictures of you like throwing footballs and stuff. So tell me a little bit about your real estate background and how you got started.
Sure. Yeah. Well, you pointed out something interesting. I was actually recruited to play football at Carnegie Mellon. But when I got to Carnegie Mellon, I just figured that the opportunity to explore my intellectual curiosities were much greater than just to play another 4 years of football. So that's what I did. And along the way, along my intellectual curiosity and exploration, I really started latching onto real estate. It wasn't that far from home for me because I came from a real estate family. My parents run a real estate brokerage firm in Silicon Valley, and they have experience in all sorts of different investments in real estate, but they never really did anything big on the commercial side until I was really tugging at them and saying, hey, there's this whole world out there. You guys shouldn't just be focusing on these small stuff or this residential stuff. And, we can really do some bigger things. So that was the beginning. And it started obviously with a lot of research and then a whole ton of networking. I can't stress enough how valuable that was to just put myself out there and be exposed to people who were really just doing what I wanted to be doing. I think that was the quickest way to push me forward. So I was working with my parents for a while on syndications, was helping them raise capital and do deals. And then eventually I met my business partner at a conference. So again, networking and putting myself out there, met my business partner and we started Lone Star Capital, which now, as you mentioned, is a multifamily owner operator with about 70 million under management.
Ooh, okay, cool. So you've grown a little bit since I read your bio. It said 50 million and now you're at 70. Tell me about the type of assets that you like to buy. Is it typically 150 units plus? What kind of multifamily value add do you like and in what markets?
I'll tell you what I'd like to buy. I'd like to buy a 250 unit deal in the best location at a very cheap price and have it cash flow well and be a no brainer deal. But those are almost impossible today. So, we still look and we bid on a lot of deals, but unfortunately we're finding the value in deals that are around the 10 million mark. We look at deals anywhere from 10 million to 50 million. We obviously prefer the larger deals because we want to grow our business, grow our portfolio, and 10 versus 50 million, they're the same amount of work. So you might as well go for the bigger ones. But what we've been really seeing, like I said, is that the value in the smaller deals, they're a little more overlooked and there's just a little more opportunity there. So we're seeing the price difference is pretty meaningful. So we've been buying a lot more smaller deals lately. So yeah, but still to your point, 150 units plus, usually a value add component. We kind of have two buckets or two strategies that we look at. We call a core plus strategy, which would be more like a 5-year plus hold, where we're really focused on the cash flow and the operations of the property and more so on the location than total returns. Whereas in our value add strategy, we're looking to exit in 18 to 36 months. And really it's a buy it, fix it, sell it scenario where we see an underperforming, undervalued asset where we can quickly reposition and then maximize the values. Those are the two strategies we have.
Okay, cool. Actually, I'm with a company that has been doing a lot of quick turnarounds as well. So a lot of times under 36 months, we go in with bridge financing for typically apartment complexes or communities that don't qualify for Fannie Freddie right off the bat. We go in there, we stabilize them, and then we resell them. But we're in the process of evolution, right? So we're looking at what other syndicators are doing, and they're typically going after buy and hold models, stuff that even if they do bridge financing, their intent from the beginning is to go into traditional financing and keep it for a 10-year type of loan product with about a 5-year turn. A lot of times because they get to capitalize on the depreciation for the first 5 years and get the best financing, interest only. But I'm curious because you're doing the exact same thing that we have been doing, at least in part of your business with the short term. Why have you decided to do that? Justify it for me a little bit instead of keeping it for a longer term.
I mean, I'm sure the deals that you've been able to exit have done really well on these quick turnarounds. There's no better way to maximize your returns than to buy and sell quickly. Every day, if you have a value add deal, every day you hold the property longer, your IRR will go down just because of the time value of money and opportunity cost and things like that. So, I mean, really that strategy is what has the opportunity to generate the highest returns. But like you said, it's usually financed with bridge loans. So people consider those higher risk, they're higher leverage. You have maturity risk. So you really need to have a business plan and an opportunity that supports the added risk and leverage of a bridge loan, right? If we can buy a deal that we could call core plus that really would generate a fine return in 5 years, let's call it 15%. Why would I buy a bridge deal that will only give me 15%? I'll just take the safer option there. So really we're seeking in our bridge loan strategy, which is the value add strategy, we're seeking returns that are higher than what we can get in a longer term. So that's why we justify the strategy, is where we see an opportunity where the projected return being higher is not only compensating us for risk, but it's also downside protection. Because with a projected higher return, if you don't hit your numbers and you don't get exactly what you want, you could still stress your exit and be able to, in a downside scenario, hopefully refi out of the bridge loan into maybe it's bridge to bridge. It just keeps the deal alive. But whatever you can do to keep the deal alive, obviously nobody wants to be forced to sell or lose a property in a recession.
Oh, you know what I want to ask you is about the cultivation of your database, because you do some stuff that's for longer term and you do some stuff that's shorter term. Do you have enough of a database where it's not a problem raising capital for either or? Do you have specific types of communication to segment parts of your database for certain types of deals? Or do all of your investors like all of your types of deals? Tell us about how you communicate with them and how on a riskier deal you profile the person that wants to invest in that versus somebody that's less risk tolerant.
Sure, that's a good question. And that actually reminded me of what I wanted to bring up, but I'll answer your question. So I don't really bifurcate my database or my list of investors. Obviously, I do have an idea in my head for what investors are looking for, especially larger investors. It's hard to keep track, obviously, with smaller retail investors that are interested in writing, $50,000 or $100,000 checks. Those types of investors, they're busy professionals. They're not really in the business of evaluating the deals too heavily and getting too involved. What they're really doing is investing with you as the sponsor. So they're investing in your platform more than the deal. So that's not as big of an issue. But, sponsor or investors or JV partners that do this for a living, obviously they're very deal centric and sponsor focused. I'm conscious of what they're looking for. So I have certain family offices or private equity groups that I know are looking for a certain return profile and certain asset and risk. Obviously, I'm going to take a deal a certain direction accordingly. And then to remind myself, so you're talking about a lot of sponsors you're seeing are going out there, putting on long-term fixed rate debt, 10-year money, and being able to just hold for longer and pitch that as a lower risk. And we saw that a lot in 2018 when the Fed was raising rates, because everybody thought bridge loans were the scariest thing because the Fed could hike us into a recession and we had higher interest rates. So why would you want to be floating when you have exposure to short-term rates that are rising? Those risks are more or less off the table, but people are still biased towards permanent fixed rate financing because they just still see a recession coming, which I don't disagree with. But the issue is those deals are not necessarily being pitched to investors as 10-year deals. I very rarely see, I don't think I've really ever seen anyone say, we're going to hold this property for 10 years, because I've actually spoken to a few people that have tried it and they've seen that their capital raisability and velocity drastically slowed when they're pitching the deal as a 10-year hold, because investors are, who knows where they're going to be in 10 years, and committing capital for a 10-year period is a big commitment. So I'm seeing all these 10-year deals being pitched as 3 to 5 year deals, which makes the exit far more uncertain if you have to deal with that. So, obviously prepayment penalties and things like that limit the exit flexibility prior to loan maturity.
So I do get the objection. Well, what if you're stuck with the deal? What happens after 2 years, and then we're stuck with bridge financing? I don't want to be stuck in this type of thing if there's a recession that hits. How do you respond to that?
Yeah, and that's going back to my point of stress testing the deal and doing an exit test. And I've spoken on exit tests a little bit here and there. I've written about it, but an exit test basically is where you take your going in bridge loan, right? Let's just call it a $10 million bridge loan going in. Obviously, a bridge loan is not based on in-place performance, because a bridge lender is believing in you, believing in your business plan that you're going to bring performance up to a higher level. So what you do is you say, okay, well, if I'm going to take a 36-month bridge loan going in at 10 million, let's look at our model and see where we're projecting our numbers to be at in 36 months. And if at 36 months, the NOI supports a permanent loan that is lower leverage, that is higher than your bridge loan, then that's good. You pass the exit test because in your base case underwriting scenario, you've been able to go in at a high leverage bridge loan, improve the performance, and then take out with permanent debt. And then the next step is, okay, well, let's stress test our 36-month NOI. So in 36 months, what if we are 5% off our revenue projection? What if we're 10% off our revenue projection? So that's one thing we look at. Then the next thing we look at is, well, what if the capital markets are different? What if interest rates are different? What if cap rates are different, right? Because maybe our NOI is there, but lenders are not willing to lend at the same valuations they once were. So then we stress valuations and interest rates. And then you put those two things together and you say, okay, worst case scenario, my revenue is down and the capital markets are hurt. So the market is valuing cash flows lower. Your cash flows are lower, and then that's your worst case scenario. And almost every deal I look at does not pass that final worst case scenario, which is a scary thing and a risk you have to be comfortable with. But like you asked me to make a rebuttal or to address that, the answer to that is, if you do end up having, let's say, a $10 million bridge loan, and then in that downside scenario, the biggest loan you could get is $9 million to take out your bridge. Well, that's $1 million gap that in the real world, rather than just give the property away, you would find a way to do a capital call for $1 million. That downside risk is, hey, if it's a recession and you've got all those adverse conditions affecting you, you are going to need to find a way to call capital, or you yourself come up with $1 million to keep the project alive. That's the downside situation that nobody really wants to talk about.
Okay, so I'm curious about working with family office. I'm actually going to interview somebody that's in a family office, and I'm still very curious about it. I know that a lot of people raise money from family office, work with family office. The few people that have been in family office that I've spoken to have been distinctly different. So it's almost like, I don't know, a romance movie versus an action movie. I mean, they're so different, at least in the types of investments. But I'm curious as to like what kind of circles they run in, how they navigate, what do they do? I have all kinds of questions. But what's been your experience about working with family office versus traditional investors?
Yeah. And when you mean they're different, do you mean family office to family office is different? Or do you mean family office versus retail investor?
No, family office, like people within family office are radically different from each other.
Yes. Well, yeah. I mean, it's hard to put them into one group and say, well, family offices like these kinds of deals and they write these kinds of checks at these terms, because they're all so different. I was speaking with a couple people that work at various family offices. They run integrated platforms. So they don't really even take outside capital or put their capital to work with outside individuals. They've built a fully integrated team to be able to handle their acquisitions and portfolio strategies. So, you see family offices like that. And then you also see family offices that they're more of a capital allocator. So they have less infrastructure and they're looking to partner with sponsors to carry out their strategy. Every family office is different. I would say, I mean, the real biggest difference is everything is a lot more scrutinized and real, because you have one person or one entity that's making a very large commitment. If it's a $5 million equity check, because if you're going to raise $50,000 from 100 people, that is a very different story, because each individual person is not going to vet the deal as hard and have all these different control rights and decision-making abilities. But if you're going to get your source of capital from one family office, no matter who they are, they're going to want control, and they definitely don't want to pay the fees that retail pays and things like that. So that's the biggest difference, is the fees and control.
You said that your parents were in Silicon Valley. Is that where you grew up?
Yeah.
Okay, so they were running a brokerage, and then take me through the process of how you evolved or how you got into your first few multifamily syndications. Did they do it without you, or were you a part of that?
Our first syndications were where we were more on the passive side. We invested a little bit of capital and we raised capital. And we were very fortunate with my dad running a business in Silicon Valley for many years. He had many relationships and many contacts. He had worked all this time and developed such a great reputation. He didn't really see himself leveraging his reputation and quality work that he had done over the years to turn into his ability to raise capital. But I mean, it actually was, it made a lot of sense. So So initially we started raising capital for other sponsors before we went and took down our own deal. And because obviously managing a syndication and running your own property is a whole nother world and a lot of work. So that's how we got started. And that's a good way to get involved because, as you know, if you're going to play even just a small role in the GP to raise a little bit of capital, it still not only one opens a lot of doors for you, it also teaches you a lot because then you're a little bit closer to the experience and you can see behind the curtain a little bit and get a better understanding of how everything works. Those two things help to then take you to your next one, right? If you played a small role on your first deal, and then you can leverage that and say, well, I'm a general partner on this deal, and we raised this much money and we did this and that, and that'll help build relationships for your next deal and to be taken more seriously and that kind of thing. So that's exactly what we did. And then we pretty quickly found ourselves buying our own deals while still looking to raise capital for other sponsors to grow those relationships. And obviously you want to go where the opportunity is. Yeah. So that's really how we did. We started with raising capital and then we transitioned to the owner operator role. And now I'm much more focused on the owner operator role rather than raising capital. I don't do too much of the traditional capital raising stuff anymore.
It sounds like you're a numbers guy when I hear you speak on conferences and whatnot. So you like underwriting, you speak at a very sophisticated level. I don't even know how to facilitate the questions for you that you can answer. I'm curious about, so you're not doing capital raising, but a lot of the stuff that you did was based off of the network that your father had already created. Did you go out at any given point in time while you were learning the business and raise some capital that didn't come from his sources? So I want to hear more about the mindset or the struggles or the success that you had on your first capital raises so that other people looking to do their first raises can relate to some of the experiences you had.
Yeah, so we've had some really big struggles and really interesting experiences. Like you said, going out on your own and trying to even cold call or just have these referrals and introductions. I had gotten on the phone with so many people, emailed so many people, pitched myself, pitched deals. It's a very trying experience, but it's a great experience because it teaches you perseverance, rejection, and all of those things. And I think that is very important. So I have had experience doing that, and I've had some from what felt like huge failures. And we had a deal that we needed to raise $3.5 million for, and it was just going very slowly. It just, for whatever reason, investors weren't liking the deal. I guess we hadn't properly groomed our relationships to be able to raise the money in the first place. We had a very difficult time, and that's when I basically, my everyday job was just to get on the phone with a new person every day and just try to make a connection, try to raise capital, just see if someone can help us out. And I was calling investors directly. I was calling capital raisers. I was calling private equity firms. I was calling co-sponsors. And so it was a crazy experience. And I'm really glad to not be in it. But at the same time, having your back against the wall and knowing that you need to raise this money and you need to get this deal done or else. I mean, we put our own money on the line. We had hundreds of thousands on the line. That's obviously a very strong motivator. It's a healthy stress if you let it be healthy for you. And I think it pushed me to get to the next levels. I kind of look at it like after a few situations like that where we've just back against the wall. How are we going to make this happen? And we think we're going to fail and then pretty much give up and then come back and all this. Once we've gotten through a few of those, now I'm kind of welcome that experience. And if I had the opportunity to put myself in that position again, I would, because I know I can make it to the other side because I already have.
Yeah, there's something that you said that really resonates with the type of capital raises that my company Bakerson has done in the past. See, we evolved from wholesaling houses to wholesaling mobile home parks and hotels. Even we started wholesaling multifamily, and then we started syndicating multifamily. So through this evolution, the way that we've communicated with people has changed significantly, because when we were wholesaling, our communication was, hey, we flipped this deal, here's your capital and your return back. Very quick, But as you're evolving into these longer term deals, the longer and longer you get, I mean, even from 1 month to 18 months or 36 months, it requires a different level of communication. And one of the things that I started this show for was to learn about capital raising techniques. And I've had a lot of people come on and say, well, you have to do it a little differently than what you're doing, because we've been able to find deals and then raise the capital for them, no problem, with what we've done in the past. But as we're evolving into this new multifamily syndication model, that's just not an effective strategy. So we've been hearing, hey, you have to create a database and let them begin to know, like, and trust you. And then they have to understand why you like multifamily. And from there, you explain the structure of the return that you give. You specify specific people that like specific types of deals. From there, you find the deal and present it to people after you've had that communication. And that's not what we've done. So we did a lot of exactly what you're talking about, like calling on the phone, calling everybody, emailing everybody, coming from a place of stress. And we're realizing now from all the people that I've spoken to on the show that that maybe not be the best way to do it. And something that you said was maybe I didn't, or we didn't, or people in general, when they're getting started, don't spend the time creating the relationships with their investor database. Have you heard, I've been getting a lot of calls from New York recently, or people connecting with me, and some in Silicon Valley actually, about these single source equity investors. And we've been typically doing deals under $5 million, but once you hit that $10 million size threshold, there's these companies, I'm not sure if you've heard of them. People are asking me if it's true that these guys exist. And I wanted to ask you, these guys that can write $2 million checks, eliminate your syndication process of going out and raising a bunch of $50,000 checks from people. There's people that will come in, and if you have a track record, they'll actually write you a one check from a single source equity investor, and then they get paid, I believe, as a broker, or they get also, because a lot of them have Series 6s and different securities licenses, they also can sometimes get paid as a GP. Have you come across these types of people?
Yeah, of course. They're equity brokers. There's many of them, and they, like you said, they typically charge 2 to 3% of the equity they raise. So if they're going to bring you $1 million, they'll just charge the deal $20,000 to $30,000. That model is cheaper than bringing capital raisers on. I'm sure you're familiar with the syndication structure where people will bring people on for a prorated share of the GP economics. That model is more expensive than simply using an equity broker. That 2-3% that they charge on equity is charged to the deal, so it's a deal cost. So basically, the investors that they bring to the table are paying for most of that, right? Because if they're going to do a traditional joint venture structure where the LP that they arrange in the deal is bringing 90% of the capital, you're responsible for 10%. You're only paying for 10% of that 2 or 3% fee. So it works, but the issue is the scrutiny that you have to go through is so great. To make it past these tests, you have to have, like you said, track record. You need to show your company has an infrastructure and operations. They much prefer to invest with sponsors that are vertically integrated and have their own property management operations in-house. So there's just a lot of things that you have to check their boxes to get that single source equity check. But it is out there, and you and I we're in the world of syndication and
Mm-hmm.
networking and podcasts. And so I think being in that world, it teaches us the value of a network. And the exact same principle is true in the more institutional private equity side of things, where you've got more sophisticated people and actually companies who do this professionally, and it's their business to deploy capital in $5 million checks and whatnot. Networking is just as important there. And I think with the right amount of effort, you can bypass the equity brokers and build direct relationships, which I think are much more likely to turn into deals done. It's just like you said, same thing is true on the syndication side with retail investors putting up 50,000. It's, in an ideal situation, it's much better to have months and months of communication, interaction, content, discussions, soft commitments, and then you have the deal and everybody's primed and ready to go and they're excited. Same thing is true with private equity investors. Building those relationships ahead of time. The best way to build those relationships also is by just talking deals. Just share them a deal. Say, hey, I'm working on this deal. Here's the package. Here's my underwriting. Here's my business plan. Let's talk it over and have private equity investor tear your deal apart. It'll be the best experience for you because you'll learn, oh gosh, maybe I was off on this assumption, or I'm not going to do that again. And then you just iterate that process and that relationship be built. You're going to have to, I don't know the number, but I would think, depending on the group, you'd want to hear no 9 times from them before they'll say yes. So get through those 9 no's as quickly as possible. And through that process, they'll see that you're diligent, you're putting yourself out there, You're actively in search of deals. Whereas if you're making that relationship with the deal on the line through an equity broker, you've cut all that groundwork beforehand out of the equation, and that just makes it a lot more challenging, especially for someone with less reputation, less track record.
You were recently on Dan Hanford's virtual summit, the Multifamily Investor Nation Summit. What did you speak about? Tell me about your experience going on conferences. Do you do a lot of conferences, or is that unique?
Yeah, I don't do a ton. I definitely would welcome the opportunity to do more. I did spend last year, 2019, a fair amount of focus on attending conferences and growing our network and things like that. For 2020, I'm doing less of that and more focused on our acquisitions and operations, because we developed some strategic partnerships that allow us to capital raise with a little bit less effort. But I think speaking at conferences is wonderful. And at Dan's MFIN recently, I spoke about deal structuring, which I think is one of my favorite topics, because I love creatively thinking about deals. And you've got a unique situation, and how can you create value by, there's just many ways, trading things of unequal value and structuring things to maximize the value to multiple parties. So I went over some basic syndication structures, and then wrinkles, and then also some nuances about promotes and private equity structures.
Very cool. Is there anything that you want to share? Any golden nuggets that you either heard or shared yourself that you would like to share with our audience?
Well, yeah, it was something that was interesting that I showed. I was sharing my screen and I was showing the model, and I had a hypothetical deal there. And I showed how the slightest change in returns to investors is a huge change to the sponsor's promote. If you think about the structure, a sponsor's promote is highly leveraged, right? So we have the leverage of the lender's debt, right? That's leveraging the deal to then having levered returns to the common equity. And then your promote is levered behind the common equities preferred return and their split. So that promote piece will go, your promote, if you hit it out of the park, could be $1 million, $2 million. And then if you just, take the returns down to a more modest, let's say, 14% or something, your promote gets real skinny at 200,000. So it's interesting. I showed how much just a little tweak to the numbers that don't really affect the investors' returns very much really just change your promote as the sponsor. So I thought that was something really interesting to actually see in the numbers.
Okay, so what do you know, or what do you think about the upcoming correction or recession? What is your belief and why?
Yeah, this is tough. I think we will have a recession in the next 2 or 3 years, and a recession just means zero to negative GDP growth for 2 consecutive quarters. So it's not like the world is, the sky is falling. The interesting thing is inflation is not meeting the Fed's target, so they for now have a free pass to lower rates however much they want, which it seems like they will likely continue to do. I think we're just going to be in a unless something changes in the world, I think we're just going to continue to be in this low growth phase, that lower for longer that everybody's talking about. I think interest rates have a bias to being lower rather than higher right now. Yeah, I don't think it's going to be a nasty recession. I think we're just going to be kind of stuck in a more stagnant economy for a while.
Well, I'm seeing a lot of rents growing. I'm seeing a lot of population growth here in Phoenix. I'm seeing a lot of economic drivers. There's nothing that I see just from a very, personal level, but I don't see anything that indicates that we're doing anything except for maybe slowing down the acceleration of growth. But everything is looking really good right now. Maybe if there's a change of power in the presidency when the election comes, but I don't really see anything. So I'm not sure where people get this concept. I guess it's just because we've been riding the roller or the thing for so long without any really slowdown.
Right.
Is that
Yeah.
why you think it is? Is that it's just the bubble will eventually burst?
Yeah, that's a big part of it. I think the most interesting economic data right now is freight and manufacturing took a big dip, and it's showing up in the numbers now. We're actually in a manufacturing and freight recession right now. Those two are typically leading indicators. So, in a recession, those two things dip first and then everything rolls over. But that's mostly due to the tariffs that were put on, I don't know what it was, 6 months ago or more, because those tariffs take a while to actually reflect in the numbers. So it could have been 6 months to even a year ago. I just can't recall. But, hopefully we kind of have a resolution and then things get more positive and then business capex resumes, because that's something that's been really interesting in today's market, is this dichotomy between consumer confidence, consumer spending, and business confidence and business spending. We've got consumer confidence at all-time highs, yet business confidence is low and business capex is very low. Businesses aren't spending if they don't have to. They're conserving cash, they're being conservative, they're preparing for a downturn, which is exact opposite of what the consumer is doing. The consumer is wealthy, wage growth is okay, they're spending. So I think the business confidence was low because people would just had so much uncertainty around the trade wars. And with a resolution, I could see those numbers normalizing, and then we're kind of, like you said, back to that nice and steady, 2% GDP. Yeah, it's a very interesting situation that we're in, and the fact that it's been so long is the scary part.
I started a new segment on my show that I'm calling the lightning round. What's your favorite deal that you've done?
Well, I'd have to say, today we're closing a deal in Lubbock, Texas. It's 228 units, and I have to say, it's my favorite deal just because I like the wrinkles of it being a loan assumption. That's my favorite deal right now. We're closing that today.
208 in Lubbock. Congrats. What's your favorite drink?
Old fashioned.
And your favorite restaurant?
That's a tough one. I'll say, just to make it interesting, I'll say Novikov in London.
Wow, okay. What's your favorite dream car, or what car would you like to be driving?
Well, actually, one of the big reasons I moved to New York is I love the fact that I don't own a car. But I would probably say a Singer 911, which is a refurbished classic Porsche 911.
Nice. I love the classic cars. Okay, how old do you want to live?
Wow, interesting. Well, considering medical technology is probably going to be so far ahead in 50 years, 60 years, I hope to be happy and healthy through 100.
Nice. I like the way you phrased that. That's power of auto-suggestion. And then your favorite travel destination that either you want to go to or that you've been to?
I want to, now that I'm not in California anymore, for Californians, Hawaii is kind of that, tropical vacation. But for people on the East Coast and in New York, there's a whole world out there of St. Bart's and, all the Bahamas and all things that way. So I haven't vacationed there. So I would like to experience that.
Okay. And then your favorite day of the year?
I have a good answer for this, but I just can't think of it. So yeah, I'm not sure.
Okay, cool, man. Thanks for entertaining me. I have fun with that segment. So I have maybe one or two more questions for you, but before we get into that, go ahead and give the audience the best way to get a hold of you. What's your website? What's the preferred method of contact for you?
Yeah, so people looking to get in touch with us can go to lonestarcapgroup.com. That's lonestarcapgroup.com. And on my website there, you can drop your email, subscribe for the newsletter. You get an intro email with all of my highlight articles, my highlight speaking engagements, and also my underwriting model package, which has my underwriting template, example models, video walkthroughs, and more. So I think that's a great place to start. And then from there, you can reach out to me directly, rob@lonestarcapgroup.com.
Okay, cool. So I heard you say earlier before we got into the lightning round that you have created some relationships with potential either general partners, structured partnerships within your business so that they can focus on the capital raising side. Tell us about the creation of those. How did you find those partners? What did you offer to them? Why did you bring them on board?
Obviously, you have to offer people market economics, so they need to know what a good deal is, because they speak to not just you but multiple sponsors. So I think in the past we've been in line with what is normal, or maybe even a little generous. The thing about the capital raisers are in the business of raising capital, so that's what they want to be doing, and they need an excuse, which is a good deal, to raise capital. So I think that's really the key, is if you have the trust and relationships, then being able to bring a deal that is sellable to investors, that's what they're really looking for. Unfortunately, sellable to investors doesn't exactly equal good deal, but that's a whole other discussion. But that's what we've done, is we've just approached people, said, hey, here's the deal, here's our business plan, this is what we're looking to do, we're willing to offer this if you want to partner with us. We've had people reach out and say, hey, I'll help you with your marketing book, so I'll help put together your marketing materials and do things like that, or maybe we'll co-host a webinar to share the deal with their investor group and things like that. So there are creative ways to kind of go the extra step.
Interesting. Okay, so I didn't know that you were developing relationships with people that raise capital for a lot of people. Have you considered bringing on somebody as a full-time capital raiser exclusively for Lone Star?
Yes, but not quite yet. But we'll probably get to that point where we'll need to have somebody that is much more outgoing and charismatic than me, and they will, take over the world. They'll be at every networking event. They'll be able to really lead our business development, whether it's debt, equity, deals, that whole thing. So absolutely.
Fascinating. Okay, it's been a lot of fun. Thank you so much for coming on the show. I wish you lots of success, and congratulations once again on your Lubbock, Texas, your 208 unit there. That's phenomenal. I mean, thank you so much for coming on the show. I really
Yeah, thanks so
appreciate it.
much. It was a fun one. I love creatively thinking about deals.